All right, good morning, everybody. We made it. So looking at what's going on around the world, Hong Kong is up more than 0.5%. UK is basically flat. Small caps down near 0.25%. The Dow more than that. S&P down closer to 0.5%, and the NASDAQ down the most at 0.75%. So we could look at that and say that small caps are down the least, and technology or NASDAQ is down the most. It's going to be a busy day today. We've got a lot of economic events on the table. We're going to get some Fed speakers as well. I think they have somebody on Bloomberg today also, which doesn't always end up, in here. So European central banks, they're going to be speaking. We've got US Fed speakers, retail sales, manufacturing, and at the end of the day, we got options expiration. So it's just going to be coming at us all day long. Some of these numbers don't look good either. It's not just, oh, well, we have business inventories and industrial production. It's these numbers and the forecast. Like, that's Canadian sales, but still from minus 1.3 down to minus 8. Now that's a decent number, but on the other side of that, manufacturing prior was minus 11.9, forecast is 0. If they don't get this 0, which is a good forecast, and instead we get that number again or something near it, we could see a reaction here. Decline on that forecast and on this one. So we just got to be careful today when we're getting these numbers. And we can already see the hedging activity as the worry starts to settle in for the morning and the events that we have on the table. We are already at the lower ADR this morning, and there's a little bit of a feature that I've noticed with these over the years. For a long time, I only had 1 day of ADR, like the way I'm showing it now. You couldn't see yesterday or the previous days. So I had to get really comfortable with the idea that I have it for today. Maybe I can take a picture, but once it's gone, it's gone. And I would notice when we got to one side really early in the day that there was a stronger opportunity to be at the other edge by the end of the day. Now, I don't know that we're going to do that. Nobody knows for sure. But it's one of the first things that I think of when I find that we're already at one of the ADR levels this early in the day. There is the perspective that the day is more than half done already anyways. And I know you don't feel that way. You just woke up. But we've been technically open since 6 o'clock last night. It's beyond 6 o'clock this morning. That's more than half of the day. So we're on the downhill slope. We're also on top of the VWAP. So, as long as we were staying underneath it, we could anticipate that bearish posture. Now we've got that tweezer bottom. We're back above the ADR half. That is setting us up for a turn and a move higher. Now, the tweezer bottom, it's not the end of everything. We had one here and we broke it and we went lower anyways. So, it's not like some kind of magic bullet that's going to stop us from going lower, but it is one signal. Getting back above the ADR is another. Back above the VWAP is another. Step by step by step. If we focus on just our own Globex range, 59.52, that's really close to 59.50, which is a big options level. We got to get through this half. Then we've got to get through the low of yesterday and then our own Globex high. Then we can start focusing on working our way back up to the other ADR half. Just remember 59.92 is a cog line. 6,000 is a big round number. It's an options level. And we've got to get through all of that if we're going to continue to move back up. Moving back up makes sense if we're going to pin at all of those levels that we've been hearing about all week from Spot Gamma and really a lot of the other places too. We've gone lower than we should have, looking at it from the perspective of all of the options structure that was around us to begin with. And from our base case idea that we were going to hold the line into options expiration, but Powell kind of pushed us out of the boat, and then we had more negative economic data coming in from around the world. So it just kind of stacked up and got us down to these levels. I mentioned that there was hedging this morning. That's front end hedging because there's always hedging. This is just additional hedging. We can see the market maker move this morning. And the idea is that this hedge or this hedging activity is because of the economic events on the docket today, because of these things. So 8:30 is kind of the big one because there's 3 events tied into that 8:30 time frame. It could be the 9:15 and maybe it's the 10. I don't think so. I think it's going to be this 8:30 one, but we don't really have to guess. After 8:30, this number should start to go down. And maybe around 9:30 after the market opens and, closer to 10 o'clock, it should be gone by then. If it wasn't the 8:30 docket that is making them hedge, it's not going to go down after 8:30. It'll stay where it is or maybe even get higher as we get closer to one of those other 2 events. The other one is at 9:15 and then there's one at 10 o'clock. So after 9:15, if it hasn't started to go down by 8:30, we're going to want to start to see that decline. If it doesn't start declining after 9:15, then we'll focus on the 10 o'clock one. I don't think we need to wait that long. I think it's going to be 8:30, but we can just validate it by looking at the movement that we get from it. If you don't have that indicator, just go to the futures options panel on the broker that you have. A market maker move, you can see it anywhere. As long as you have an options chain to look at that has these average implied vols. So this is the front end. It's the one that's going to expire today. When that front number is higher than the next expiration out, you've got what they call a market maker move. All right, that's all it is. And it's something that Thinkorswim made up years ago. Okay, it's just something that they realized had value, it had merit. So they call it the market maker move. They didn't even make it for futures. They made it for equities, generally for earnings or drug trials, big known events that start to hit because it's hedging activity. I'm the one that just took it out and started applying it on the futures and recognizing, that they were hedging with it. You can find articles on the market maker move on the Schwab website. They'll explain it and they'll tell you pretty much what I just told you. So we want to see that hedging decline after the 8:30 time frame. Still keep your eye on the clock through the day today. And the base case estimate is that we're going to come back up and get to the upper ADR, at least that. Now, the good thing is we can prepare for the trading day and we can have an alternate thesis. So while my base case argument is we're going to go up and hit the other side, that's off the table if we come back down and take out our own Globex low. In that case, forget the upper edge. Let's run it into the ground. We'll target the lower ADR. We'll get through that, which is also the COG line, 5911. Cut through the round number at 5,900 and look for an expansion down into 58, maybe 58.50, but 58 feels better. And just run the other side. All right, so we got our base case argument and our alternate thesis. $58.92 COG line is really close to the halfback on this really big day from November 6th. That would line us up really close with the daily 20-period moving average. And if we overshoot that, we can get into 58.32 COG line, which is the 10-week moving average. So we talked about the floor pivot on the week earlier in the week. We're there. We made it down here in the overnight, and we've come up off of it. Generally speaking, the ES likes to stay above its weekly pivot. Now, we've been below it before. Got a good example of last week when we were below it before we got above it and then continued to run. And we opened with a bit of a handicap this week, already extended from that weekly. And we just really wasn't able to continue that drive farther away from the weekly pivot. But we've come back down and we've reset at this point. One, that ought to set us up really nice for next week. Two, this needs to hold, which kind of goes into what I was saying a minute ago. If we break this low, well, let's focus on retracing this really big move that we had on the 6th. Because a lot of that move on the 6th was done in the overnight hours. In the regular trading hours, we really didn't do much that day. The biggest part of that move happened in the after hours. And I think that if we break this floor pivot on the week, we could really start to challenge those gains that we got in that overnight session. Consider it unfinished business for 5,800 all the way down here at the previous weekly floor pivot. For this morning, the daily floor pivot channel is completely below the previous days, and price opened up underneath it. Both of those are a bearish bias. It's wider than the previous one. Wide channels imply that we won't break out, and if we do, that we come back in again. So this kind of says that we should come back inside of yesterday's range. Now, these channels don't make price do anything, so just kind of keep that in mind, right? It can hint that we're not supposed to break out, and that if we do, we come back in. But when we got economic events on the schedule, it's going to take precedent over gamma levels and central pivot ranges. So earlier in the week, we talked about this zone up here and how we really needed to stay in this zone, or it sets us up for an air pocket of risk, this being the air pocket. When there's not a lot of structure, price can run through it really fast. Well, the same thing can happen in reverse, and we can run through it really fast. And while 58.50 is a reasonable target, I think if we break this structure and cut our own low here, that 58 seems more reasonable than 58.50. You can look around and very likely find that we can bounce on something at 58.50. Even though we don't have a high volume node, I'm sure we have plenty of other things. I just don't think it's going to be enough. Yeah, I think it will act more as a speed bump than a floor or a wall. So we had the high volume node in the first group. We've got the second high volume node here. And that's the one that needs to hold. That's what we're challenging right now with the low that we've got. It's the weekly floor pivot. It's the bottom of this high value, high volume node. And it's the last point before we get into this air pocket. If we're looking for any sort of assistance, like coming down and hitting an iceberg or hitting some sort of support through trading activity, we didn't really get all that much. Well, looky there. The put wall that used to be so far away I had to scroll for it is now right up in our face. That is, to me, a bearish signal. You know, we know that OpEx today is going to cause a lot of options to expire, but so many companies, they don't let them expire. They just go ahead and roll before that expiry. They didn't roll into a new spot, right? They didn't keep it down there where it was, way down here. They rolled it up. And sure, yesterday when they rolled it up to where we were. They didn't roll it over our head, right? They weren't getting them in the money. But it's over our head now. If you generally see a put roll up and they just roll it closer to us, that's a bullish bias. But they didn't roll it closer to us. They rolled it right up to where we were going into the close. So if we don't get back above that fast, then it's going to be a bearish bias. One of the things that's making me negative about it is they didn't roll that call wall. They rolled the put wall. Then what the call wall's likely to expire or get rolled. I don't expect these two to stay together like this very long. And for all we know, this could be a put wall just by default, right? If you read Spot Gamma's notes, there's times where they know they have to give us a put wall. And so they'll look at the spot with the highest notional value and they'll say, okay, well, technically that's your put wall, but it's really weak and it doesn't have a lot of structure. And right, it could be that situation. If all those puts that we did have way down here are just, they're getting ready to expire and they took them off, but they didn't roll any. And now that they're gone, you run the scan and like, oh, well, this area has a lot of puts. I guess that's the new put wall. So it could be that situation, right? I don't want to read too much into it yet. Let's get through options expiration, look at it on Monday, see where the put wall is at that point, because we would be expecting that through the day today, they're going to be building their new positions, right? So that ought to give us some clarity Monday, Tuesday. So don't freak out too much on that put wall yet. I just don't like it there. Zero gamma level underneath the 10-day. We got the 3-week supporting us. As I mentioned, if that weekly pivot or the 3-week moving average, the zero gamma, the ADR, if all of this doesn't hold and we break that 5,900, I think we got a nice drop through the air pocket today. But my base case is that all of this holds and we come back up and we get to this upper ADR today. To do that, we got to get back through the 10-day moving average. We got to get through this put wall now and through the volatility trigger. Generally, when we have hedging, we have low volume. But we've got a lot of volume today, and we got hedging. Now, when it comes to this market maker move and this hedging activity, there's two times where I caution people that it may be misleading, that maybe it's not telling us what we think it is. One of those times is when we swap to a new contract. Right now, we're still using the December series and we have 35 days left. We're going to roll out of this December series in about a month. So that's not the reason for the market maker move. But when we do get that move and we swap to March, we'll see during that whole week, we'll see the market maker move lie to us often. The other time is when there's a big options expiration, because they're rolling out of those options that they have that are about to expire and they're putting them somewhere else. And that activity, that trading activity in the out of the money options gets picked up as if it's hedging activity when it really isn't. So if this market maker move label doesn't go away all day today, we'll know that it's only there because they're rolling out of those front end contracts and it's being misinterpreted as hedging when it really isn't hedging. $10-day, 30-minute volume profile, we're basically at the last hurrah. But now that we've pulled away from this point of control up here, if we move back towards it, it's likely to act as a resistance. It wasn't expected to be resistance as long as we were staying near it. We could just crisscross back and forth through it as much as we want. But now that we've left that range, if we attempt to run back to it, it's likely going to be a resist function. You can see the air pocket here a lot better. There's really nothing left if we get below the low that we've created. Yeah, we're already underneath this highest point. And that leaves us with an air pocket. We have a new VPOC level since we hit this one from maybe a couple months back. No, not even that far. From 11.6, that same day that we've been talking about, the 11.6. So we just took out the point of control for that one. Technically, we should leave it on for the whole day. So I'm going to leave it there, but we have a new one from yesterday. And now that we've hit it, it's not a VPOC. It's just a POC. Just want to make it a little bit different so I don't mistake it for something that it's not in the middle of today's trading. $59.92 cog line will front run this VPOC from yesterday. So, you know, I mentioned all those things that we've got to run through to go back up. And now one of those things is 59.93, a VPOC level. All right, we have next week's range on the table. It's not set in stone yet. It's still moving, and it will continue to move all day today. But after the close today, it'll lock into place, just like all these previous weeks are locked into place. But throughout the day right now, the gray line is representing where price is. And so as price moves up and down, the gray line and these other two lines are going to also shift up and down. The width of this box is based on volatility. So when volatility is really high, the box gets wider. And when volatility is really low, the box gets more narrow. It's also based on time. This is a 5-day box. So it's calculating with the square root of time and 16 and VIX and everything else is all piled into this. It's calculating a 1 standard deviation move. Even though it's not set in stone yet, we can use it on Friday mornings or even throughout the day today to ask, what does next week's volatility look like compared to this week's volatility? How wide is our week's range or expected move? Is it significantly bigger or smaller than the week that we just had? Now you can, get all engineer on this thing and break out your calculator and nerd it. I just draw a sloppy little box on the week that we have and drag it over and set it on the week that we're about to get. If they're close, then it's close enough. Next week's volatility structure looks a lot like this week's volatility structure. Not a lot. That can change throughout the day today, and we'll examine it again on Monday. But at the moment, the market is looking at next week pretty much like it looked at this week. Well, we had a lot of things on the table this week that are concerning that would have caused people to, load up on some volatility hedges. The fact that it's a narrow range should not make you think that there's nothing on the docket for next week. There are volatility suppressing events like FOMC and NVIDIA's earnings that will give us a narrow range. And I know if you're thinking, dude, FOMC, they make big moves on those days. It's the least, nothing like a volatility suppression. I get it. But before we get to FOMC, before we get to NVIDIA's earnings, the market is very likely going to go sideways in this, quote, hurry up and wait mode while we're waiting on it. And that sideways lack of movement means a lack of volatility. The last NVIDIA earnings, Monday and Tuesday and Wednesday, were some of the narrowest days that I've seen in a long time in the S&P. They were very narrow. The markets weren't interested in anything. They wanted that earnings. And NVIDIA's earnings is coming. So it's very likely that this narrow range is a projection suggesting that we're going to go sideways and wait on NVIDIA. We are still 2% above the 10-week moving average, and that's a good spot to be. We're not overextended or overbought. We're not overstretched. It doesn't owe us anything. That's just a good, healthy place to be, 2% above the 10-week. We are below the 10-day, but the day isn't done. And this is like a good reset. You ride above the 10 for a while, pull back to it, get a little reset, and then run it again. We could go below. Sure, we've been below it before. But at this point, we're back into the center of the basketball court. We could move 1.5% below it, above it. In either direction, we could move that far. And it wouldn't even be considered an outsized move. We wouldn't be out of bounds. It wouldn't be overbought or oversold. So consider what a 1.5% move would look like in the S&P. That would just get us started, right? That wouldn't even be too much. When we started the week, almost every one of these tags and labels were in the blue. And now we've got 3 left, really only 2, because that one's about to turn orange. So that leaves energy and banks. And as long as that 10-2 is still above zero, then you don't want to short those banks. And energy's been getting a lot of positive activity. Notice we're not necessarily saying crude, right? That XLE is way more than just one basket like crude. It's just straight up energy, doing really good still compared to everything else. If we think about that rising tide and falling tide, we'd be looking for the next wave, like waves in the ocean. If that's the sea level and we're just running in those waves, looking at all of those orange boxes, I'd say it puts us in that part of the wave. All right, so we got chips down, nat gas, technology, cloud computing. Uranium is just shy of what we need. We want like a 0.5% here, and we're just slightly underneath it. And we got the Mag 7 down, but also just not quite down enough to meet our criteria. It's hard to imagine a trend day or a rally day or a recovery day when we don't have cloud computing, technology, the Mag 7, semiconductor chips. We don't have any of that, and we kind of need it. Don't have financials either. They're negative. They're just not negative by very much. See XLF down here too. So if we're going to get one of those rally days or recovery days, then you want to continue to keep your eye on the Mag 7, technology, cloud computing, consumer discretionary. You want those sort of names today to either not fall or run, right? If they don't fall and just hold sideways, we can get some 0-day flows in the indexes, and that can make us run. But we got to have something, right? So either some really good 0-day flows or the Mag 7 technology, consumer discretionary financials, or both. We gotta have something. We're not going to rally without it because we can't run on Bitcoin, China ADRs, and gold, right? That's just not going to work. So we got to look. Bonds are positive, but they're not up enough to meet our criteria, and it looks like they're falling. They're likely going to go to zero again for up on the day. Precious metals and mining. I mean, gold was down, 9% in 5 days. It makes sense that we're getting a little bit of a dead cat bounce and we're popping back up some. China ADRs, they were down almost 8%, looks like. So again, a dead cat bounce, a little pop to the upside. Plus Baidu or Baba, one of those ADRs had earnings that weren't horrible. Bitcoin continuing to be a beast. It's up 14% in 5 days. That's a pretty impressive number. And the VIX woke up. It's up 4% this morning. So we can have this rally day that I was talking about where we go back to the other side by the end of the day. But we're going to need some assistance from technology, consumer discretionary, the chips and or just some really solid 0-day flows. All right, 20% of the S&P 100 is down, at least a 0.5%. And 2 names in the S&P are up. So 2% of the S&P is up. That's not a bullish number, right? But this lines up with why I think we can get to the other side by the end of the day. For the NASDAQ, only 2 names are up a 0.5% or more. But 40, yes, awesome. 40% of the NASDAQ 100 is down at least a 0.5%. So if we're going to go to the other side, run back up and say, hit the 1-day estimated move on the top side, then we need to stay above the 0 gamma level, get through the volatility trigger. We got the 2-year falling, the dollar falling. We can do it. Especially if we can get this rug pull where we've got 50%, 40% of the NASDAQ down. Yeah, trap some bears, flip it, rip it, run it back up, right? So I did this at the beginning. We'll just finish it the same way. Highlight our own Globex range. You've got the halfback level. Get through the halfback to challenge yesterday's low, and then get through our own Globex high, and then start focusing on a move back up to get to the ADR levels by the end of the day on the top side. 6,000. To get there, you've got 59.92 cog line to get through as well. Then the round number, 6,000, and then 6,002, right? Nothing to it. We can do that, no problem. If we reject on this halfback and we can't get through it, then the target is back to the lower ADR half. Once we get through that, we take out this low, and then it's game on to the downside. And that would be the liquidity zone and the 1, 2, 3, 6 for a digest. Get through that, then the cog line and the lower ADR full, and then that air pocket that we were focused on. Nothing to it, right? So that's what I got today is watch the market maker move. Have a good weekend.